Throughout 2016, Copen sells its products. In this unit, we are going to analyze and post this transaction. Before that, let's recall the previous unit. It focused on the analysis and posting of the purchase of machinery on April 1st, 2016. Cash flow, that's to say, collections and payments. In 2016, Copen paid up the purchased machinery. Regarding the income statement, that's to say, incomes and expenses, it's good to remember that the mere act of purchasing the machine does not involve any expense, since in exchange of money the company acquires a good of equal value. However, the machine gets exhausted over time, which should be reported through the depreciation expense in 2016. Finally, this transaction involves two changes on the asset side, in addition to cash balance. On the one hand, the balance sheet now reports the machine at its purchase price. On the other hand, by means of the accumulated depreciation, the balance sheet reflects the loss of value of the machine since its acquisition date. As mentioned above, the transaction that we are analyzing in this unit refers to the sales of products in 2016. Firstly, as we did before, we identify the possible collections and payments that could have taken place in 2016 due to the sale of products. In a nutshell, we will determine the possible cash inflows or cash outflows related to this transaction in 2016. The wording states that Copen sells on a credit basis. In particular, they collect the amount due to 2 months after the sale. The sales corresponding to the period between January and October and therefore collected in 2016. However, the sales corresponding to November will be collected 2 months later, in January 2017, while the sales corresponding to December will also be collected 2 months later, in February 2017. The cash flow table reflects now those collections. In this case, the intermediate calculations illustrate and justify how the result was obtained, by multiplying monthly sales by the number of months and by the price per unit. We identify now the potential incomes and/or expenses accrued in 2016 regarding the sale of products. We can state that the sale of products will generate incomes if the company's value increases, or in other words, if Copen's wealth increases due to that transaction. On the other hand, if the company value decreases, or in other words, if Copen's wealth decreases due to the sale of products, we will be able to state that this transaction involves an expense. As has been said several times, it's important not to forget that within the context, company means the entire company shareholders unit. When Copen sells its products, the company's value increases, that's to say, Copen's wealth rises. That's why it can be assured that the sales of products generates a type of income that is known as revenue. But the sale also implies that the company, the supplier, is no longer the owner of the product sold, which in turn reduces company's value. In a nutshell, by selling products, the company's wealth also decreases. That's why it can be stated that the cost of goods sold is an expense. What's the trick? If revenues are greater than expenses, the company will make a profit. On the basis of the data provided by the wording, we can calculate the revenues incurred in 2016. We just need to multiply the price per unit by the amount of units sold. As can be seen, the revenues in 2016, 900,000 euros, are greater than the collective revenues in 2016, 750,000 euros. It's due to the fact that Copen sells on a credit basis, since they collect their sales 2 months after these take place. This once again shows the difference between incomes, an increase in company's value, and collections, any cash inflow. In this case, the cost of the goods sold is only determined by their acquisition price, every single unit at 15 euros. The income statement reflects now both the revenue and the cost of goods sold. As usual, intermediate calculations are sound. The cost of raw materials was an asset until those were sold. This expense should be only recognized when Copen transfers the ownership of those goods. That's to say, when Copen sells the goods. That's why company's value does not decrease until they sell those products, since the value of the purchased products equals their purchase price. At this point, we can already calculate some partial results that are included within the format of the income statement. For example, EBITDA, which means earnings before interest, taxes, depreciations, and amortizations. According to the name of the first partial result, this requires subtracting labor and general expenses and cost of goods sold from the revenues. If we subtract depreciation expenses from EBITDA, we will get EBIT, which means earnings before interest and taxes. And if we subtract the financial expenses, interest, from EBIT, we will get the earnings before taxes. If the company had incurred financial incomes, for example, interest obtained from bank accounts, this should be added up to the EBIT. Finally, we analyze whether the sale of products affects to other assets other than cash, liabilities, or capital. In other words, we need to assess whether the sale of products may lead to variations in the belongings, the rights, the liabilities, or the capital of the company. Two different assets change. On the one hand, by selling on a credit basis, the company acquired the right to collect in 2017 the revenues incurred in November and December 2016. At December 31st, 2016, the customers who bought goods to Copen in November and December 2016 owe the selling price to the company. This debt should be settled in 2017, and in essence, it shows a Copen's right to be paid that the company's balance sheet at December 31st, 2016 should reflect. Let's recall that all the items belonging to the company are reflected on the asset side of the balance sheet, be they cash, goods, tangible or intangible, financial assets like share or bonds, or rights like the rights to be paid. But on the other hand, a second consequence of the sale of products should be posted. Copen does not own the sold products anymore. Copen's inventories therefore are reduced. Let's recall that when we posted the purchase of raw materials, we could not close the balance of inventories because we also need to account for the effect of sales. Well, at this point, we can subtract the cost of goods sold from the already posted cost of the purchased goods. As well, as we also need to record on the current assets section the right to collect the sales for November and December 2016, whose payment is pending at December 31st, 2016. Let's remember that the current assets section reports all those assets that the company expects to turn into cash within 1 year, that's to say, in 2017. Let's summarize this unit. In this unit, we have accounted for the transaction describing the sales of the company in 2016. Regarding cash flow, that's to say collections and payments, we recorded the collection of the revenues incurred between January and October. The income statement now shows the revenues incurred in 2016 and the cost of goods sold in that period. Furthermore, we obtained some partial results up to the net income before taxes. Finally, this transaction had two implications for the balance sheet, in addition to the effect on cash. First, we recorded the debt of Copen's customer related to the sales in November and December 2016, and secondly, the decrease in inventories due to the sale of products. In the next video, we analyze and account for the transaction describing the corporate tax payable for 2016.